Good afternoon, everyone. Welcome to the Tax Risk Management webinar. My name is Suzanne Smit. I'm an admitted attorney and a master tax practitioner registered with SITE. My professional background, my tax career started in tax disputes, and together with tax disputes currently, I also advise on cross-border tax and exchange control transactions, as well as domestic and international corporate structures. Some estate planning as well, but just a general overview of my background. There are a few areas today to cover in terms of tax risk management. My aim is to be informative, practical, and relevant. We have a wide audience attending, so some of you may be familiar with some of the concepts, but please bear with me because I want to cater for everyone attending at the webinar, and I will attempt to add value in each instance. We will cover international and domestic aspects of tax risk management. We will focus from multinational enterprises right through to small businesses. So whether you are with a multinational audit firm or if you are a tax practitioner in the countryside, hopefully this webinar will be of value for you. I'm not going to go through the exact content. We will follow the outline of the slides. And to that, I will add additional information and expand on the different aspects that's covered. We will start with what is tax risk management, and it can be many things, and it could be summarized in so many different ways. You would see that it says it entails the process of understanding, interpreting, and applying tax laws in order to mitigate tax risks. Ultimately, for me, it comes down to managing uncertainty within a tax context. In terms of uncertainty within the tax context, we all know that tax acts are open to interpretation, and you cannot prevent having a tax risk or more to manage, but you have to anticipate it, manage it, and mitigate potential consequences that may be attached thereto. So I think one of the key concepts is to understand and interpret tax laws within a business environment or as a taxpayer. It's vitally important to employ suitably qualified and experienced people at a large business or multinational enterprise level. And then also within that context, you've got different levels where to employ specific people. The question may be asked, where does tax risk stem from? So it could be from a number of sources and levels within an organization or within the taxpayer's organizational structure. It could be a specific transaction or disclosure or the lack of a disclosure, which ultimately may trigger a tax risk. Tax risk may be in the form of an additional assessment which is issued by SARS with additional imposed penalties and interest. It could be a tax dispute that has to be managed throughout the process with SARS. It could be a default which should be voluntarily disclosed should it comply with Section 227 of the Tax Administration Act. It could also entail the omission in a tax return, which could be seen and perceived by the taxpayer as a bona fide inadvertent error, but would be regarded by SARS as much more grave than just a normal error. Normally, in the case of multinational enterprises and larger businesses, tax risks or uncertain tax events have to be reported and quantified to its audit and or tax risk committees on a regular basis. It's really important from a good governance perspective, and also in South Africa, King 4 principles apply, which we will later discuss in a bit more detail. I think the important part in terms of what tax risk management is that it's no longer confined just to tax laws and applying tax laws and complying, but it has developed into a moral and ethic characteristics which should be considered by a taxpayer within its immediate and broader context. The reason why I'm saying that is if you are involved in a specific transaction that may have an impact on third parties that's not necessarily involved in the specific transaction but may have adverse consequences for them, it may be prudent to consult wider than just focusing on the specific transaction. Put otherwise, tax risk management is mitigating a taxpayer's risk in relation to its entire tax function, from the planning phase right through to compliance and then disputes which may arise from a specific return or transactional disclosure. It is required to ensure that a specific tax position is verified, and as basic as ensuring that the tax return that's submitted is without any omissions or mistakes. A taxpayer may decide on its risk appetite in relation to confirming a tax policy within the organization. This will normally, the tax risk policy or the tax policy would normally be a document that's resolved by the directors, the board of directors, and would be based on what they believe is prudent, taking into account the nature of the business and the complexities of transactions it enters into. The tax policy or the tax risk policy will also then dictate the measure of management required in relation to any tax risk which may arise in the tax function. I think quite important, if you Google Vodafone's tax risk policy, it's available on the web, it's in a PDF format. That is really a good example of what a tax risk policy would look like, and it sets out specific focus areas, it sets out certain points of movement. So knowing exactly what you cannot compromise and what you cannot stand for, and then also the room to maneuver within that space. I forgot to say in the beginning of the webinar, please feel free to type your Q&As. I will leave about 20 minutes at the end if there are any Q&As to answer. So there's the chat box, and then just below there's the Q&A box for you to type any questions that you may have. So the characteristics that I just mentioned in terms of the tax risk, etc. In South Africa, it's formally embedded in King 4, where it's part and parcel of good corporate governance. I will go into a bit more detail later with King 4, but it goes beyond ensuring that tax or shareholders rather have peace of mind, but that there's an obligation to ensure that all stakeholders are satisfied that the taxpayer is not only in good standing from a financial perspective, but that it's tax transparent and that it transacts responsibly. You can only think of large corporates making headlines in recent times, both domestically and internationally. Then moving on to the next slide, tax risk management is really dependent on people. Sorry, it's the same slide. People, processes, and systems. It's dependent on ensuring that the people that you employ or who you consult with do have the necessary skills, experience, and expertise, and that there's that current developments in terms of tax policy, domestically and worldwide, is taken into consideration together with the context in which the taxpayer operates in. At the end, I will also share some practical tips to actually consider your tax risk management strategy or in advising a client. I mentioned that prior advice is really important. I think where you enter into a more complex transaction that you are acquainted with, it's really important that you get external advice, be it from an independent tax practitioner or be it from a senior advocate from specializing in tax. I do think, especially if the tax position is sensitive, it will be prudent to consult and take external tax advice to make sure that your tax position is verified.